everybody, and welcome back to Eggs. Today's special guest is Jason Kirby. Jason is the co-founder and CEO at Thunder VC, a digital broker democratizing access to capital for venture-backable startups. As a serial entrepreneur, Jason is and has been the executive leader of 4 different startups that have been acquired or sold and have raised more than a combined $40 million. This experience and his acquired knowledge uniquely qualify him for his present role at Thunder VC. You see, Jason is passionate about serving founders and capital allocators. He's been exposed to what it takes to build a company from the inside out, taking a strong vision and packaging it up for success. From creative services to education, HR tech, gaming, cloud infrastructure, and beyond, he has a proven track record of success that shows that his systems and strategies designed to get your business funded are industry agnostic. Joining us today for a conversation covering topics like fundraising from angels and VCs, joining an existing startup as an executive, why and when you should or shouldn't raise capital, and more, plucked from his experience scaling, building, and exiting businesses. Please join us in welcoming to the show CEO and founder at Thunder VC, Jason Kirby. Hey, Jason, how are you?
Hey, nice to have you. Thanks for having me.
Yeah, absolutely.
Yeah, no worries.
To death.
Yeah, no, really appreciate you making time for us.
Yeah, this will be a fun conversation. We haven't had a lot of people on the show to talk specifically about fundraising and things of that sort, but it is a commonly requested subject. Obviously, a lot of the people who listen to this show have an entrepreneurial journey of their own. A lot of them are startup founders and are, maybe getting to a point where they could use money. So I think it'll be great to talk about it. But maybe we start with a little bit of background on you. So maybe we can talk about your experience just sort of as a young entrepreneur and how you got to where you are today.
Yeah, no, happy to share. My entrepreneurial journey started really early, back in college, 19, taking business classes, not interesting at all. Was kind of curious as to how to apply what I was learning into any kind of actionable experience. And I went on a bender on basically diving into business books when I was 19 over the summer, and started to understand the concept of entrepreneurship and what it means to run a business and what comes with that, and decided just to kind of start a business for the sake of starting a business back then. That was following my passion at that time was photography. I was like, I do something that I love. And a mentor of mine kind of once said, if you do something you love, the money will follow, never chase the money, because you'll end up kind of chasing money that doesn't give you quality or satisfaction of what you do and lead to future regrets down the road. So pursued a business and taking photos and kind of being something fun to start with. Didn't realize it was going to scale up to what it did, to be one of the largest event photography and headshot photography businesses in San Diego. And then eventually launching the largest photography school in San Diego at the time. The thousands of students taking my classes, whether it be moms or, enthusiasts or travelers wanting better pictures. And I found a niche there. But what I realized quickly after a few years of running those businesses is I didn't really love photography. I loved running businesses. And that was something that I had a hard realization with, and decided to deprioritize those businesses and try to launch a tech startup, go raise money and move on to something much bigger. To which I crashed and burned miserably trying to raise money and chasing all the wrong investors. Had no idea what I was doing. We had built a successful business. It was growing pretty substantially, about 40% month over month. By any standards in today's VC world, that would be considered, very fundable.
Was this your photography business or was this another venture?
This is a startup. So basically, I kind of packaged up my small business to be self-operating with minimal input from me, and then went to pursue more of a tech startup with a friend of mine that was in a similar space. It was a photography marketplace for people to identify, find and book photographers directly. So we had fixed price packages. So you'd have to go back and forth and negotiate. It was like the easiest way to book a photographer that was out there at the time. It was a lot of fun. I really enjoyed that scaling a business opportunity, raised a little bit of angel money, but just could not raise venture capital back in 2013 in San Diego. Just was non-existent. It was an ecosystem I had no familiarity with at all. Chased all the wrong investors. It's like, oh, you have money, I want to pitch you. And it was like total waste of time, and learned a lot in that business. Towards the end, we got an acquisition offer from Kodak. I knew the CMO at the time. It was an awesome opportunity. We're like, all right, let's go all in on this, and fell through in the final hour. So very depressing and disheartening. Kind of was burnt out on San Diego. It was all about lifestyle businesses and, going to the beach and surfing. I wanted to build, a real company. So my wife and I moved out to New York, where I joined as the chief revenue officer. Well, technically I started as a chief marketing officer at a company called Liquid Sky, which had a really interesting product enabling people to play any game on any device, targeting gamers. I took them from basically a small beta tester group of users to about 1.8 million users in 130 countries, growing to basically become this, well-recognized brand in the space of gaming, negotiating big partnerships. Got an amazing acquisition offer from Samsung. It was an awesome experience. It was amazing. And then the day of closing for Samsung, literally the day of, like, bottles of champagne in the office, ready to go, deal gets killed. It's a long story, but essentially Samsung had a bunch of hierarchy, management changes, management shifts, and the first order of business on day one of their signature authority of the new management was to kill every deal on the table.
Wow.
So that was a huge blow. Just talk about coming to the office, because we got the message at like 2 a.m. in the morning, because, South Korea time, start a business there. So we come to the office. None of our team knows that we're getting acquired. It was just like 5 people on the team that knew. And we had to come to the office and basically pretend business as usual.
Oh, man.
That was brutal.
That would be.
But I forgot to mention, so at that company went on to raise about 12 million throughout the course of our time there, raising a couple of million after the Samsung deal fell apart, to which we had to kind of pivot quickly because we were burning cash on the consumer side, to pivot to commercial or B2B and going into enterprise. So we started selling contracts, sold a 7-figure contract to Walmart, Verizon, and 6-figure contracts with like LG, KT Telecom, and a couple are big telecoms out globally, and basically pivoted the business, the model, and everything, while basically chasing an acquisition with Walmart, which inevitably came true. At the end of 2018, Walmart acquired us. It was a home run for everyone. We were super excited for that to happen. We go to Walmart, we get this monstrous budget to go and scale what would have been known as Walmart Gaming. Super exciting opportunity, tons of resources to make it happen, a lot of support from management. And then about a month before E3, which is a popular gaming conference in June every year in 2019, the CEOs of Walmart, Doug Millen, just decided that that's not the route that they should go as a company. And they wanted to double down on next day delivery and compete with Amazon on 2-day delivery, all that kind of stuff. And they took our massive budget, which at the time was around 600 million for the next 3 years,
Wow.
to zero. And I've had a lot of ups and downs.
Well, no, I think that's something that's really appealing to me about your story, is that you do have these ups and downs, and they're sort of integral to the process. I think there's a lot of, especially young entrepreneurs, that think they're going to, I don't know, maybe somehow be able to skip steps, or that just getting money is the solution and that kind of thing. And so I think that hearing your story about these sort of ups and downs, and the fact that, each opportunity sort of built on the next opportunity, and even though it flopped, like, it still sort of fed into the next thing. So even though Samsung bailed, Walmart came in, then Walmart bailed, and then I think it's interesting to hear that trajectory, because I'm not sure that everybody, at least in their mind's eye, sees it going that way.
Yeah, because as an entrepreneur, your job is to paint a rosy picture. You're always selling the upside. You're always selling the positive, because no one wants to write a check or buy a product from a company that's struggling or dealing with external or internal issues. So, but that's our reality. I've never walked into a startup either as a consultant, an advisor, an investor, an employee, and there wasn't a total disaster internally, or from some perspective. And it's a matter of how you mitigate those problems and how you handle those problems that leads to a successful outcome. And I deal with hundreds, if not thousands, of companies on a regular basis, and it's just constant chaos internally. But you're the CEO, you're the founder, your management. You always have to paint a rosy picture. And so, from the outside looking, from the outside, everything, this company's amazing, they're doing great, and then, you have actually no idea that it's probably a total disaster and everyone's hair's on fire. Probably just how you are feeling right now. And so I always like to kind of put that context and kind of put founders at ease of like, you're not alone. It's a disaster for everyone. And one hell of a journey. So
you've had both roles. You've been a founder and you've worked in a team of other people on another project. Can you maybe set the stage for both sides of that equation? What it's like working as the founder, deciding you need capital, and then going into a established kind of setting where you're not necessarily the founder, but you're out there working for the same goal. Are there major differences in the two?
For me personally, I never act as if there is a difference because I typically come in as in the C-suite for a startup or at a hot, an investor or advisor role. So I'm always like at the very strategic position of the company. And I feel like you have to have skin in the game or act like you have a substantial amount of skin in the game to make the proper decisions. And I feel there's kind of like there's mercenaries, and then there's like soldiers. Again, can't speak today. Like there's people that like enlist and opt in because they believe in like a bigger mission, and then there are people that are there to get paid. And albeit the mercenaries serve a very important purpose and they provide a lot of value to a lot of companies, but depending on the stage, the role, and the experience that you're looking for, mercenaries can kill a company.
Mm-hmm.
When you come in and you're specifically aligned, specifically on monetary, personal success, it can be a misalignment in terms of company goals and doesn't allow you to be as agile or flexible in a early stage startup. Typically, like hiring mercenaries at early stage that require high salaries, benefits, like the full like safe package, usually can be detrimental to an early stage startup because one, they often can't afford it, and two, the incentive alignments are not always pure. And I always come in as if I'm going to be the founder. I always take a much lower salary than market with a bigger chunk of equity, because that's what motivates me, and that helps me align my role and output to the company with the company's success. So that's something that I always try to frame this discussion around when it comes to talking to founders or looking at potential roles or advising people that want to get a role at a company. If you're more on the mercenary side, go to the big tech companies, go to the big companies that can pay you the safe salary and be comfortable. But if you really want to have an impact and have autonomy and flexibility in building something from the ground up, which is not meant for everyone by any means. It's a lot more work, a lot more stressful, less pay, usually not a successful outcome. And you really have to be in it for the right reasons and believe in what the company is doing and be behind its mission. In order, I should use the word missionary versus mercenary is more the proper terminology. So you really want to, if you're a CEO or founder looking to hire on, team members early stage, so like pre-seed, seed, Series A stage, you want to be hiring missionaries. And I always position myself coming in as a missionary to companies, or otherwise I wouldn't join. Like if you don't love or you're not passionate about what you're going to do at work every day, you just can't succeed in those miserable environments because there is no structure. It's chaos all the time. And, decisions are constantly changing and you kind of have to deal with that. As much as you said yesterday, you're going to go right, and then tomorrow you're going left, that makes a lot of people go insane and, hate their job. But if you buy into the mission and you can follow the decision-making towards why you went right the other day and now you're going left, it's a lot easier to kind of roll with those punches.
Yeah, that makes complete sense.
Yeah. And I think that's right. Yeah.
Oh, can you tell us what you're currently doing now? What is Thunder VC and why did you start it?
Well, shortly after the Walmart experience, I got put up on the roof, which you're familiar with, the Silicon Valley, TV show where they get put up on the roof and forgotten about. That's basically what happened. They treated me well. I can't complain. Walmart was a great experience. But in that time, I went and joined another startup called Generation Esports. Basically helped them raise about $11 million Series A. That was a bunch of ups and downs, all kinds of chaos, but got them to about $1.5 million a quarter in revenue, raised a Series A. And then after that, I was like, okay, I've done this a few times. I've became an angel investor, started investing in other companies. And I started looking at, this is a disaster of a process. Raising capital sucks. It's a full-time job. So is running your company. And they're not usually coincided. Like it's usually two separate giant efforts that you have to push forward. And I found myself when raising money or with my founders raising money, often we're talking to the wrong people. You get in the room, you get an introduction, you do what you think you're supposed to do, but you get in the room with the wrong person.
Mm-hmm. Been there.
Yeah. And investors don't like to say no. They like to keep options open. Maybe you do become a success that fits into their investment thesis. So they'd rather have you on the sidelines as a backup option than just saying you're not a fit. So founders spend a lot of time chasing the wrong people. And when I flipped on to the other side of things as an angel investor, I was like, this also sucks because I get inundated with irrelevant deal flow, things that I do not care about, things I have zero interest in supporting as an advisor and investor. And it was just overwhelming to kind of like, how do I pick the winners? How do I get what I actually want? And so that led me to reconnecting with a VC firm here in New York called Interplay Ventures, where we launched something called Thunder.vc, which we've coined as like kind of like a network for VCs, founders, investors that uses AI to identify who has a higher probability of investing in who. So basically what we have today is the list that you start with when it comes to fundraising. So whether you're already in the market fundraising or you will be in the market, what matters most is who's actually capable and willing and interested in writing a check into your business. And so our algorithms basically identify that out of a pool of 3,500 investors or VC firms mostly, based on your company data, your traction, your profile, your stage, how much you're raising. We're able to identify like, hey, here's the 50 or here's the 60 or 100 or 10 investors that are more likely to invest in you. And these are the ones you want to go deep. Like these are the ones that you want to know who their portcos are, maybe get an introduction from their one of their portfolio founders, or you reach out to them on LinkedIn, follow them, see if you can meet them at an event, whatever it is. Those are the people that matter that you want to go and actually build what I would consider a real relationship with, which is how most capital is deployed. It's not often that you'll run into an investor, have a chat or two, and raise $500,000 without an existing relationship or an incredible warm intro from a very credible source. So basically we built Thunder to help streamline the process of identifying who you want to be talking to, so that you can double down all your efforts on your fundraise for that specifically, as opposed to trying to scrape from a million lists or Google a million different things. And like it often could take weeks for you just to compile a list of VCs to which you don't necessarily have the expansive, whole VC market taken into consideration. Whereas we're not necessarily 100% yet, but we're adding a couple hundred VC profiles a week at this point.
Wow.
And we're at about 3,500 or so that you're being scored against. So your company will come in, and out of 3,500, we're like, only about 30 match with you. Like, don't waste your time trying to chase these other people, because 98% chance of not amounting to anything. And VC, one problem is you might land a meeting with a VC that has zero interest in you, and that VC is just basically getting information on your market.
Yeah.
Like they're just like, oh, that was fun. I really enjoyed meeting with you. All right, bye. And they think zero interest in investing. They don't give you a no. And you sit there and like, wow, they're really happy. We're going to follow up. Let's get that next meeting. Oh, I haven't heard from them in a while. Let me keep following up. And you put all this energy and effort because you got a positive vibe. But in reality, they just sucked you for information, and they're on their way.
Yeah.
Do you
and maybe Mike can speak more to this experience, but I think that because obviously he's pursued funding before, and basically it seems that he sort of ran into this problem, right, where the VC didn't have the skills or the relationship or the whatever to actually serve him all that well. They were willing to take his money, and they were willing to say, yeah, we'll give it the good old college try, but they weren't really the right people to do it. So I think that your concept is awesome, because I can't imagine how many hours are spent with especially young, hungry entrepreneurs that are just like kind of desperate and they need the money. And, that's the only thing they see is the money that they've got to raise. And, so anybody who's kind to them feels like a good choice.
And that's a dangerous, slippery slope. It's like you're not getting necessarily the right people in your cap table that can support you growing. And also founders, there's like this kind of, I don't want to call it toxic, but misleading advice out there that founders have to be like persistent with investors and like hunt them down and like spam them to death because you got that one chance. Like you're saying I got a chance, kind of mindset. And it's just like it's so detrimental to the mental health of the founder that they often neglect what really matters, like traction and building the actual business and growing revenue. And founders often will feel like, like, oh, that VC's for sure. Like they were super interested in us. They're definitely going to invest. And then it's like crickets. But they kind of told people that it's going to be something, and then it ends up not being something. So it's just something that I really warn founders on. But just make sure you're talking to the right people that can actually move the needle for you. And
well, and it makes sense, it's not unlike looking for a new customer or something, right? You need to know who your customer is, right? If you're going to serve them. This is a reverse equation where you're trying to get money brought into a company, but ultimately you're seeking a partnership or a relationship or whatever that would be no different than any other kind of relationship you might have in your business. And so why wouldn't you take the time to get to know them, right? So I think it's, I think that's a good way of looking at it anyway.
And it's often a 10-year relationship too. Private companies aren't going public anytime soon. And, these people often sit on your board. They'll be talking to you on a regular basis. Like you want to make sure you like them and that they have value to add over time beyond just a check. Like, especially for like a lead investor, the person that's like leading the round, setting the terms, those are the people you want to have a close relationship. The other investors, like you want to make sure maybe they have connections or relevant value to add. That's always good. But sometimes it is just about money, and that's not necessarily wrong. But whoever's going to be your lead investor, you want to make sure you're pretty close and tight with, because they're going to have a lot of influence over your next several years.
So let's take a step back and talk about founders who might not necessarily need money or know that they're in a position where they need to go out and get money to grow and scale. When should a founder actually look into going that next step and actually taking that step and trying to raise money for, round A or, whatever is necessary in their business? Some people, can build a pretty small business that doesn't take a lot to manage and has a lot of passive just income. Why would they want to screw that up and bring other people into the equation?
Like that's something I try to speak on quite a bit is if you have the ability to build a profitable business, why raise money? And if you are profitable, you can raise debt. And if you're if you're smart with how you take on debt and you're able to have the proper cash flows to pay down debt, like you make your life a lot easier. Especially if you get to, a couple $100,000 in revenue, $1 million in revenue, getting debt is pretty easy to grow or take your business to the next level if that's what you desire. So I always like to make sure I tell founders, like, do you really want and need, in particular, venture capital? It's a very specific profile of company that raises venture. And, you could very much create a profitable business and get bought by a private equity fund. And that's a great outcome. Like you were cash flowing for a while and now you get this big lump sum. Awesome. Move on to something else. That's a great path. There's just cash flowing it or putting in a manager and just having it as an asset that pays you. Those are all great outcomes. And there's just too much sex appeal about venture capital that makes founders feel they have to go for venture capital. Mm-hmm. When in reality, you should try to build a business that preferably doesn't have to require venture capital, because that's a hell of a lot. Not always easier. Every business is hard, but chasing investors in addition to building a business is like I said, 2 full-time jobs, and you need to make sure that's the right path for you. And so a couple of things I ask founders is like, are you building a venture backable company? I've talked to a lot of founders. They have awesome businesses, but like you might do $10-20 million a year at best. That's not venture backable. Venture funds, how they operate, they have limited partners. They have investors that invest in them that they have to then deliver an outsized return that outperforms the S&P. Like that's it's tied up capital for 10 years. You have to deliver pretty solid returns, typically targeting like 20% IRR, if not higher. And they have to have big wins, and they have to have those 100x opportunities. They invest $5 million, or let's say $1 million in you at a $5 million valuation. Like, you need to get to a $500 million, $1 billion outcome. And they have to factor in things like dilution and all these other things that lead to, what the actual payout might be. And I don't know if we want to get into the complexity of cap table structures and dilution and fundraising rounds and how they subsequently make you have a much smaller percentage of your company. Like, I forgot what Elon Musk, Elon Musk, like, most notorious successful entrepreneur of all time, like, he only owns like a fraction of, Tesla. Like, it's still the one of the largest shareholders, but it's still like, he doesn't own 100%.
Yeah.
He only owns like, because he's raised so much money over the years.
But the amount that he actually owns is pretty significant in reality. But you're right. He doesn't own the whole thing. That's for sure.
Yeah. How many people can build multiple $100 billion plus companies? Like, he's one of a kind.
Yeah.
But, like, and something I also like to tell people is, like, if you have the ability, if you're not necessarily venture backable, or, you don't have that $1 billion potential outcome, because that's really the marker, is like, how can you look at your product to the addressable market and reverse engineer a way of how you're going to get to 100 million plus in revenue, and how you're going to do it at an escalate, like a very high growth rate. Because not only do you have to have a big growth opportunity, a big market, you have to do it fast, because that's what venture capital is for, is to help you hyperscale and acquire market share faster than other companies. And if you see you have that potential and your business can do that, you have to ask yourself, do you want to give up control to accelerate that process and maybe make it slightly easier, because now you have more resources, but as opposed to doing it slow and steady with less resources. But that's something that I always challenge founders to ask, is once you go down the venture capital path, you never stop fundraising, because a VC doesn't want to write you a check at your seed stage for $1 million and have you never raise money again. Mm-hmm. They need those markups. They need to go back to their LPs, and they need to show that you priced your round, your priced round went up 10x. So you raised at 5, now you're at 50. Like, that's what they need to go back to their LPs by. That's what they're incentivized by. And they're going to push you and lead you towards a path that, allows you to raise more capital. And that means more dilution. That means maybe you had 2 founders, you were 50-50. Now you're 40-40. Now you're 30-30. Now you're like 15-50. It's just like, it can keep getting more and more diluted over time, to where maybe you get to $1 billion outcome, but you only own like 10%. So it's $100 million exit, which, hey, that doesn't suck. But you might have been able to build that company slower, with more control, less stress, and sold it for 150 million and kept all of it.
Yeah.
So that's something I always like to just put in founders' head as a thought exercise. Because, like, some venture companies, some companies have to raise capital. Like, they can't build what they need to build without a substantial amount of capital up front.
Is there like a hybrid scenario where you don't necessarily need like $1 million, but you need 300 grand to hire a couple developers to get you off the ground? Is there like a scenario where that works, or is it all in, go for broke?
Oh no, 100%. You, like, that's basically friends and family and angel rounds. Like, that's what those rounds exist for. That's not necessarily like an asset class per se, like venture capital is, but that's another path. Is, hey, a couple wealthy people that have industry experience that can write you 50K, 100K checks. You get a couple of those in, get $500,000, and you get to profitability in a year. Like, that's a home run. Like, that's great. And if you don't want to pursue additional capital, or you're happy where you're at, like, just reflect. As a founder, like, take a minute to reflect. What's the end game for you personally? Like, do you want the glory of the $1 billion exit and chasing venture capital and all the press and, kind of ego boost that builds, with also all the negatives that come with it? Or are you happy with just the fact that you got a couple really close people on your cap table that helped you kind of get to a profitability state, and you're paying them dividends, or maybe a private equity fund buys you out, or you get acquired by a competitor or something like that? Those are just things that you need to evaluate as a founder and ask yourself what's appropriate for you. Because raising angel money in a lot of cases could be a lot easier, because you just have to kind of convince a few individuals that their incentives or alignment is not misguided. Not misguided is not the right word, but like a VC LP investment alignment can be very different than what you want for your business and what they want for your business. Whereas like an angel investor often comes in because they believe in you as a founder, or they feel they can add value to you. And that's typically why someone writes an angel check. And that's why I write angel checks, is I believe in like the founder, I like the market, I like the opportunity, and I think I can add value. If I can't check those boxes, it's not going to be worth my time. And you can't raise $20 million through angels. That's very difficult. But you can also pursue family offices. If you kind of look at, you don't necessarily think you're venture backable, but you think you could be profitable. Another path is pursuing family offices. Family offices are essentially a wealthy family, that has made money doing something, and they have, 100+ million usually at their disposal that they're investing, or assets under management. And they sometimes like private investments, whether that be real estate or tech or startups or private equity. And they can be a little bit more autonomous in their decisions, and could be potentially more aligned with you. Now, they're harder to come by, usually all through networking and personal relationships. Groups like YPO and EO are where you typically can find access to those higher net worth individuals, but kind of have to have access to those places too. So it's difficult for people that maybe don't come from those backgrounds.
Does Thunder VC kind of work with both types, or are you mainly looking for the whales, the larger?
We best serve venture backable companies. It's just how our data set is optimized, because angel investors are they don't have like a set investment thesis for the most part. Maybe some super angels that make a lot of investments, but most angel investors write like 3-4 checks in a lifetime. Like they're not like professional private investors. They're just like a dentist who knows a guy who thought something was cool. So it's hard to really ramp up a technology platform that scales to that audience. Same with family offices. The saying goes, once you met one family office, you met one family office. They're not, none of them are alike. Like, whether it's the 5th generation, running the firm, or it's a hired, manager, or it's, the patriarch, the person that, made the money in the first place. Like, it's all over the map. They don't even touch venture, or they're all about venture, or they're over leveraged in venture. Like, it's just, all the stories are so different. So being able to articulate and capture that information is very difficult, especially because they don't want anyone to know how wealthy they are. So they don't like to necessarily say, yeah, we'll write $1 million checks into early stage startups, because that would mean that they're usually deploying probably like 30 to 50 million in that asset class if they're writing individual $1 million checks. And so like they don't necessarily want that kind of information public about their finances, or be able to reverse engineer that kind of thing. So public profiles or any kind of knowledge about their investment history is much harder to come by when it comes to family offices.
So what kind of data are you gathering on potential VCs and founders to be able to make sure they're a good fit? And then also on that same question, are there safeguards in place to prevent matching with someone who might have a conflict of interest? So say, for example, your photo company in the beginning, if you were to, go and throw your pitch deck in front of another company that worked in that industry and they just stole your ideas and ran, are there safeguards in place to maybe prevent that from happening?
I'll start with that one. Anyone that is fearful of their idea being stolen simply by sharing a pitch deck usually doesn't have a defensible business idea. Either it's too easily replicable, which is not ideal. It means you don't have what's known as a moat. That's always an important characteristic for VC funds. Is like, what's your moat? Like, how do you defend against competition? And if you don't have a good answer to that, and you're scared that a VC firm having your deck could lead to someone stealing your business and making you worthless, like, then you probably maybe shouldn't pursue that business, or you should probably reevaluate your product, or pivot, or rethink your process. Like, it's almost impossible to, not impossible, it's difficult to raise capital as a first-time founder under the notion of fear that someone could steal your idea. You will almost never raise capital in that situation. It's one, that mindset doesn't lead to success in a lot of cases. And two, the defensibility. If you feel your idea could be that easily stolen, no investor is gonna, like, VCs don't sign NDAs. Sure. They're not gonna look at your deck and they're not gonna like, oh, sign my NDA before I send you my deck. Now, if you're Sam Altman of OpenAI, if you're like a known entrepreneur that's had tremendous success, you could garner that kind of relationship. But in most cases, you're a first-time nobody founder. No one's going to sign your NDA. No one's going to care. Yeah. And, like, you need to impress them first and show them you have something worth their time. So that's my thoughts on that. So we don't necessarily have safeguards, like, and also so how our technology works is, as a founder, it's kind of like a free version. You populate your data. VCs can choose to connect with you directly. So they can basically just see your overview page and the deck that you publish. And the VC can make a decision on that and reach out to you through the platform. That's free. But then we have like our premium access, which right now is $500 a year, which unlocks all your investors. So now you see all the investors you match with, the ones that could see you, now you can see them. And you can reach out to them through the platform, and you get all their portfolio history, like what investments they've made, who are the partners, what investments, what's their average check size, their first investment check size. That's always something that's misleading, is like, what's their first check? Because that's all you care about. They might write $10 million checks in your Series B, but they're only writing 500K checks today. Mm-hmm. And so you need to know, like, they're writing 500K checks today. And what sectors they focus on, what sectors they've historically invested in, what do they say they do versus what they actually do, what product stages they'd like to come in at, how early they really like to come in, what revenue they want to see typically before considering you. What else? Geography. So some are like, we only invest in New York City companies, and some are like, we'll invest globally. So some have very specific geographic requirements. So these are all very, and like some, traction as well. So like, what's your ARR, your MRR, what's your, growth of month over month, what's your burn rate, how much cash do you have left? Like, all those types of things are the things that we take into consideration when basically generating our scores. So we generate a company score that generates puts you on a bell curve with the rest of the network of, like, where are you on the bell curve? Are you exceptional and you're on the outlier? Or are you kind of in the midst of everyone else? Or are you kind of on the negative? Like, you don't have necessarily the right traction or right components yet to be attractive to venture capital. Only about 67% of the we're at like 3,000, 2,500 companies right now. Only about 67% have more than 5 matches. Like, we are very particular on quality of basically vetting these companies prior to them being able to reach out to VCs. So not everyone that joins, like, if you don't have hardly any matches, that could be an inclination that you're not necessarily ready for venture capital or a good fit for venture capital. And you need to not necessarily just solely go off our algorithms, but, rethink how you're approaching your fundraise. Like, you're going to have a much harder time fundraising if our AI can't see the potential in you. Mm-hmm. Not to say it's 100% accurate for every single company. It's like, yeah, we certainly have some companies that have low scores and still raise, but it could be an indicator, like a leading indicator of whether or not you're going to be successful. Which, if you guys want, I'm going to talk about, like, how to test the waters if you're able to actually raise capital or not.
Actually, that would be, because one of my questions was going to be, what indicators are you looking for in a founder that could actually take something somewhere? I mean, are you looking for revenue coming in, or are you looking for just a great idea? Are you, there's a lot of different variables that come into play on a pitch deck, for example, potential revenue, this, that, et cetera.
Yeah, it's funny. I was going to ask sort of the same thing, but I wondered, before we went full blown on that path, is there assistance at your platform? So, like, if we rate low, like, do you guys give advice to try and help people with their decks? Or is it sort of like, okay, you got a low score, go back and think about it again?
So we're working on that. So we have a content series. We have different partners. We have like a deck design partner that basically produces some of the best decks I've seen for early stage startups. So we have like referral partners. So we don't necessarily do it 100% ourselves, but we try to guide founders based on where they're at. here's some solutions that might support you. Just because trying to do it all ourselves would be,
Sure.
pretty cumbersome and not necessarily mean we're the best for it.
Yeah. No, okay. I was just curious. Okay. So process.
Okay. So under the assumption that you've already gone through the process as a founder to decide whether or not venture capital is something you want to pursue, let's say you decide, I want to try venture capital. When you've gotten to that point, you have a couple choices. Like, you can try to raise money super early, but you'll have a couple headwinds against you. If you don't have traction, if you don't have a product to market, you're outsourcing your development to some overseas tech team. You are, you don't have a technical co-founder, and you're building tech. You often will probably be unlikely to raise any kind of institutional capital. It's not to say you couldn't raise angel capital from friends and family or some high net worth individuals that believe in what you're attempting to do, but you probably don't want to pursue venture capital yet until you have some of these boxes checked. So you got a good founding team that's capable of getting a product to market. Could be just an MVP. And then you want to basically validate some of your assumptions. So that could be something as simple as building a landing page that promises what you're going to build is going to come to reality, and people just need to submit their email. So you kind of have like this intent to buy or intent to, follow or subscribe, or whatever the incentive is, and be able to monitor that traction. It's like, okay, you don't necessarily have the product ready, but you're building a list, and that list is growing at some attractive rate. Usually like 10% month over month is like the bottom threshold for early stage. If you can't grow 10% month over month, probably not venture backable. Or wait until you get to that percentage or higher and before you go out and try to raise. Because again, if you're like, you have 50 users one month and then 30 the next, and 16, if you're all over the place and it's blotchy, VCs are just like, hey, very interesting, but come back to me later. Which brings me to the next point. Once you kind of feel like you have yourself packaged up, maybe not perfect, maybe not flawless, but like you feel like you got something and you think it's fundable, best thing to do, of course, I recommend start with Thunder. Find kind of the lower scoring VCs. So we have like, score 0 to 100, anything over 70 is like awesome. Anything between 67 is pretty solid. Anything between, 50 and 60 is like maybe hit or miss. And then everything under 40, 50, maybe not going to have much success. So I would start with those lower ranking VCs and just pitch them, get a meeting with them. I'd only maybe do 5 meetings, maybe 10. And what you're trying to gauge there is you pitch your heart out, you do your best, and you basically gauge where you're at in the process based on feedback. If a VC goes, are you raising money now? Like, all right, how much are you raising? If they start asking about the capital raise and they're not necessarily tearing you apart on the idea or the product, they're really interested in what you're raising, how much you're raising, what's your cap table. If they start showing those kind of signals, you can probably raise money. If you get you get a couple nuggets of information, they show some interest, they say, let's stay in touch, let's follow up. Like, let's touch base when you kind of accomplish whatever milestone. Like, you're onto something. You didn't waste your time. You're onto something, but you're maybe not just yet ready. It's not to say you can't raise money at this point. You probably could, but it's going to be a hard journey. You're gonna spend a lot of time pitching a lot of investors to make that happen. And you have to then make the decision: is your time better spent chasing all these investors and going through a 6-month fundraising cycle or longer? Or do you want to just bury your head on execution for the next 3 months, hit those milestones, and then consolidate your fundraise into a month or 2? So that's, the risk and games you got to play and decisions you got to make as a founder. But if you get that kind of like good feedback, like, oh, maybe you tweak this, maybe tweak that, and you're getting like an engaged conversation with a VC, you have potential. If you pitch a VC and they're not engaging on the fundraise, they're not engaging on like the core aspects of the business, they're not like asking for more information to better understand the concept. If they're just kind of like, okay, cool, thanks for coming by, it's dead. You don't have a chance. Like if you, and like, again, that's why I say pitch 5, 10, maybe investors, and go with whatever the majority is. So if you have like, if you pitch 5 and 3 are kind of like in the feedback stage, kind of like, oh, like in between, you got some potential. And I would go, then you got to make that tough choice of operate or fundraise. But if you get like 3 that are kind of like, oh, well, hey, it was nice meeting you. Good luck. And, keep, keep us updated. Sure. It's like kind of dismissive, not super engaged. They might show disrespectful body behavior in the pitch. Game of like that one, that VC is dead to you at that point. Don't ever, like, you can maybe send a nice follow-up to be respectful, but it's pretty much dead. And once that VC has had that kind of feeling towards you, it's almost like once a VC's made a decision, it's like almost impossible to reverse it.
Mm-hmm.
Like it is very, very rare that a VC gives you a no or kind of implies a no or kind of ghosts you and comes back. Like, and that's what I try to tell founders, like, don't chase those people. You burnt them. And that's why I say start with the lower, and when it comes to Thunder, start with those lower scoring VCs first. Then, test the market, see where you're at, so you don't burn the better matches.
Yeah, that makes sense because you're pretty much in the development stage of your pitch in general, and what you might need to tweak here and there and do this or that before you go and chase the big dogs. You don't want to come with them with a half-baked dish.
So, yeah, exactly. Yeah. And also just pitching along the way, like it's one thing like let's say you need money in 6 months. Like you want to like, that's when you have to go raise money. Like it may be not a bad idea to start just networking with VCs now and just sharing your thoughts and ideas on the market, your business, meeting them at events, sending them industry related article, like just trying to build a rapport with a VC prior to you needing money. Because it's always easy to raise money when you don't need it. That's the irony of fundraising. It's a disaster. It's like when you need money, you go out, no one wants you. But when you don't need money, they're like, hey, what you got going on over there? You start getting cold. Like if you're building a good business, that has some notable traction, maybe got some press or anything like that, you might get VCs reaching out to you. And that's ultimately what you really want. You want to build a business where VCs come to you, but that's obviously very difficult. But it's not impossible. And so that's something to just, kind of keep in mind. Most of those times, those founders that are getting reached out to from VCs are usually like Ivy League, big tech, like check a lot of like the stereotypical boxes of success. And, though that's kind of like an automated filter for VCs to like, they'll reach out to you just to kind of see what you're up to. But it's not unusual for you to start building relationships with VCs early and just be communicating, shooting the shit with them. When you're actually ready to raise capital, they might try to take you off market before you even go. They might try to give you a term sheet before you actually go to market, because if they really believe in you, they'll try to take action before you go to market. So that's kind of like how you test the waters and kind of decide where you're at and what you should be doing when it comes to your fundraise.
Yeah, it's so funny. I mean, and we've touched on it a couple of times, but like how much of this just has to do with the personal relationship, right? I think especially for maybe first-time fundraisers, there's sort of this mentality that you're kind of going to somebody hat in hand, like, I need your money, please give me your money. And you're not looking at it in sort of a two-way street kind of thing, right? Like, I mean, yes, I need your money, but I'm going to give you back a lot of money. Like, I'm going to give you back more than you're giving me. So, it really is a two-way street. And like, so I don't know, you should be going into these things head held high, right? Like, because you're, not somehow less than. And so when you start seeing the negative body language, or you start to see these things that aren't working out, all these red flags that you called out, it's like, just like any relationship, right? I mean, like if you're not gelling, if it isn't working, like to your point earlier, you don't want a long-term relationship with this guy, probably, right? You don't want to go back and have to convince him that what you've got is the right thing to get his money. Rather you want him to buy into the vision or whatever. And so much of it really is just sort of that interpersonal kind of, relationship and looking for the right partner or the right vibe, as much as it is anything else.
Completely agree. And another interesting, note for founders to take into consideration is market dynamics. Like what we experienced in end of 2020 and 2021 was an anomaly, and a lot of founders feel like it was free money out of the market.
Mm-hmm.
And it was very founder friendly terms. There's a lot of founders coming to market right now for the next round that, are kind of getting punched in the face coming to the market now, because there's a lot of down rounds. The down rounds effectively where you raised whatever 5 million at a $50 million valuation. Now you're raising 10 on 20, like that's, raising 10 million on a $20 million valuation. That hurts, but that's just kind of what's happened. Like, you maybe sold a sexy bill of goods, but you didn't really hit your milestones. The market, comps have plummeted. So your valuation is going down. And I think a lot of founders just need to, especially if you're raising your first round, don't look at the last 2 years for reference.
Yeah.
Because I still see a couple. I think most founders are catching on now, but I still see founders like, we're raising $1 million on a $15 million valuation pre-product. I'm like, bad idea. Raise $1 million and let them set the terms. It's now an investor market. So investors coming in are going to set the terms. Yeah, you can always set, a safe note, which is like a convertible note. It's like an easy, low cost way of raising money. Is often a preferred method for like a angel round or like a pre-seed round, because it doesn't require a lot of legal work and converting stock and all that kind of stuff. It's basically just a promissory note, like, I owe you this stock at this point in time if these parameters work out. And if you sell early or the business collapse, like, it's very easy to wipe out. So that a lot of founders will raise on a safe note, and sometimes we'll set the terms. But typically you should be expecting to dilute your business by around 15 to 30% on your first round. So that's like, if you're raising $1 million, maybe at a $5 million valuation or a $4 million valuation or $3. So like, that's kind of like a starting point of reference, because there is not really a science to early stage fundraising, because you probably pre-revenue, you're not getting like a multiple on your revenue like you would for an established business. So just kind of keep those in mind as a founder, just because that's something that a lot of founders have trouble understanding. And
yeah, I wondered if you could sort of add on to, our conversation about sort of this early stage stuff. Like, how do we know a good deal, for example? Like, I mean, maybe, to Mike's question earlier about, safeguards and things like that. And sort of, you mentioned that maybe the mindset is the issue, right? Don't be afraid somebody's going to steal your idea. Like, is there any reason to be afraid that people you might be talking to are, I don't know, more sophisticated than you and taking advantage, or, offering you not enough money for you to be successful, but taking the whole thing? Like, I mean, are there red flags that we should watch out for in an offer, I guess is the point.
It really comes like, you as a founder, you're expected to know your business. You're expected to know how much capital you need to succeed. And right now in particular, you need to be raising for 18 to 24 months of runway and to hit the next fundraising milestone. So again, venture-backed companies looking to raise consecutively over time. The process is basically, okay, if you're going to raise $1 million today for a pre-seed, say a pre-seed round, you're going to raise, $1 million. Like, you need to get to like $250,000 to $500,000 run rate of revenue before you can raise another round. And so you need to make sure that $1 million is going to get you to like $500,000 in revenue or more at a good velocity in order to raise capital again. And so you always need to be, when you're planning out your fundraise and how much capital you need to make sure you have the potential to hit those milestones. So if you think you can hit $500,000 in revenue by 12 months, you definitely need 18 months of runway, because you're never right. Early stage is always a disaster when it comes to predictability. You either accelerate way past it, or you really struggle to kind of hit the metrics, and you always want a little more wiggle room. And if you're going out and taking the time to fundraise, raising $500,000 versus raising $1 million is almost kind of similar. It's the same amount of work. So you maybe target some different people, but the effort's still the same. So you're better off positioning yourself to raise, for that 18, 24 month runway. So to kind of like bring that back to your question, if a VC or an investor is interested in investing in you and they're not giving you the terms that allow you to succeed, like, you need to know that as a business. Now, where they can get tricky, where there could be, some terms in the term sheet that could be of concern would be like things to look out for would be liquidation preferences, non-dilution clauses, things that could hurt your future fundraise. Because sometimes early stage VCs don't really do this because they know it will basically butcher your ability to raise capital down the road. But like Series A, seed Series A, Series B, like you can see some pretty aggressive, gnarly terms where maybe there's a 2x liquidation preference. So maybe what that means is you raise $5 million for them, but the first 10 million in an exit goes straight to them. So if you sell for 9 million, they get everything.
$1 million.
Well, you don't know them, but they get 100% of the money.
Yeah.
So like if you don't have a massively successful outcome, if you're not like growing like crazy and having a massive outcome, that liquidation preference could wipe away your return. For you as a founder, like you're a common shareholder, your investors are preferred shareholders in those later stage rounds. So typically like a Series A. And beyond, sometimes you'll see it in seed rounds where they'll do an equity round and that will get preferred shares, meaning they have preferential treatment over common shareholders. So your employees, you as a founder, are often common shareholders, and you kind of get the butt end of whatever's left over in the sale. So, for example, you're raising 10 million on a $50 million valuation, and there's a 2x lick pref on that capital. So let's just say you sell for 50 million, a year later or whatever. 20 million goes straight to those investors first. And well, there's 3 different ways to lick prefs. I'm not going to go into all of them, but you can look up it. You can look into it, but there's different options and how the term sheets are written. But this is why you want a good lawyer on your side or a good advisor that knows how this stuff works. Don't hire your dad's lawyer who doesn't do startup law. Like you want a lawyer, you want potentially, depending on how big the deal is, you might want a personal lawyer and a company lawyer that both have startup experience. Because what your personal lawyer can do is he can protect you and your best interest, and he's legally obligated to do that, or he or she. And the company lawyer is in the best interest of the company, and that could be getting the money regardless of terms. So you might want to have like,
so you're essentially
scale.
having them go to battle for each individual person in the negotiation rounds. So your personal lawyer is looking out for you, the business is looking out for the business, and that way you can get the best of both worlds by having both.
Especially if you're a novice, like you haven't had the experience, or you don't maybe have the network of people or advisors to kind of coach you through this. If you can't access that, I would really try and say you should push to kind of build a network of people that can support you in the startup world. But that's a longer story. But effectively, like that lick pref story, so you sell for 50 million, 20 million goes straight back to those investors. And then they potentially, depending on the options, could also participate in the common shares. So they can then convert to common shares and get their 20% of the 30 million as well. So they're walking away with 26 million, leaving only 24 million to be spread out amongst the previous investors, the founders and employees and so on. Yeah. So you might think you're getting a 50 million. Oh, like I own 20%. I'm going to get $10 million. Yeah, you might get like 4. Still, hey, $4 million doesn't suck. But just expectations hurt. Like when you think, oh, I own 1%, or like you're an employee or whatever, you're a founder, you own 20%. You don't really own like the company sells for 100 million. You aren't actually getting 20%. Like there's the pref stack, there's debt, there's legal fees, closing costs. That all usually gets paid out first, and whatever's left over gets distributed amongst the common shareholders. Mm-hmm. So again, one negative mark for raising venture is the complexity of the exit, which you all strive to have, but it's not always like awesome.
Yeah. There's so many scenarios to take into consideration. Even as just say a developer going into work for your startup, like do you have the ability to look at the agreements that have been made to see if your 1% is even worthwhile, or do you negotiate for the higher salary just knowing that that's what you're going for and the main focus at the moment?
Like as an employee, when I go into a company as an employee, I ask for what the pref stack is. Like,
That's good
what's
to
the
know.
preferential stack? So I know if we sell for 100 million, what's my potential outcome? And if it's pretty high pref stack, I'm going to ask for a bigger chunk of equity, because I'm obviously not going to get I'm not going to get 1%. I'm going to get probably like 0.75% of the actual payout. So, that's something always to kind of keep in mind, especially early stage startups. Like, cause you just kind of, they give you a nice round number, like, hey, you're going to get 1%, especially like early, they still use percentages. And it's and then you always you're in the shower like, oh, what if we sell for $1 billion? I'm going to get
right.
You're playing that game and it's like, well, you didn't factor in that there was 4 more rounds of financing at 20% dilution each time, and you didn't get a re-up, and didn't get refreshed. Like, it's a lot of complexity, and that's another podcast.
Yeah. Totally. Well, we've taken a quick short dive into the finance world, and we appreciate your time, and thank you for making time for us. I really, really enjoyed this conversation. So can you tell people where they can reach out to get in touch with you, how they can find out more about your company?
Yeah, of course. Probably best way is just reach out to me on Thunder. So thunder.vc is the URL. My email is jason@thunder.vc. And you can follow me on LinkedIn. It's just Jason R. Kirby is the URL, or LinkedIn/Jason R. Kirby. Those are usually the best mediums to connect with me, or that's why I post most of my content on LinkedIn. I need to get better at Twitter. I'm not very good at it. Not as active. I just either repost what I put on LinkedIn or nothing at all. So I'm pretty bad at Twitter. But if you hit me up on Twitter, I'll probably see it. I'm like, oh, got something happen on Twitter.
Awesome. Well, yeah, thanks so much, Jason. This has been awesome, super insightful, and obviously starts to unravel the complexities involved in all this stuff. But I think this was a great primer. So thanks for that.
Yeah, no, thanks for having me, guys. Appreciate it.
Absolutely. And thanks so much to everybody who tunes into the show this week and every week. And we'll see you guys next time.